Good afternoon, good evening, everyone, wherever you are in the world. My name is Saket Modi, and I'm delighted to welcome you to this session on the impact of COVID-19 on IFRS financial statements. I hope you're all well and safe. I'm also delighted to have Homyar Vikes as the guest presenter for this session. Both Homyar and I come with experience in international financial reporting and analysis, in particular IFRS. And as Square Mile Global Consulting, which is my company, we provide training on IFRS, the International Financial Reporting Standards, and the International Public Sector Accounting Standards. But we also offer e-learning courses on blockchain, cybersecurity, and data analytics. And these are accredited by the organization which consists of the American Institute of Certified Public Accountants and the Chartered Institute of Management Accountants, CIMA. And we also have a partnership with the World Class Manager to offer an e-learning program on managerial development. And given the current circumstances, we've got some amazing offers on these programs. So if you are interested, do get in touch with us afterwards. But I'm going to just start off with an overview of IFRS, the International Financial Reporting Standards. And what these are is a set of standards which are used by large listed companies mainly for their consolidated financial statements. So I prefer to call it like a global financial reporting language because now it has been adopted or used in some form, or countries have their accounting standards which are based on IFRS. And that's in more than half the world, in more than 140 countries now. So the benefit of the international financial reporting language is that it brings transparency and comparability to the financial information that is presented by various companies. And this helps users make informed decisions. So what we are going to focus on today in this session is the impact of COVID-19 on IFRS financial statements. Now, we all know that the world has turned upside down in the last 3 or 4 months. And who would have believed that at the outset of the year? But Bill Gates apparently said in his 2015 TED Talk that if anything killed over 10 million people in the next few decades, it's not going to be war, it's quite likely to be a highly infectious virus. And how much I hope that the world had probably done something about it. But we live in a world of coronavirus. It has affected businesses, and this has implications for financial reporting, financial analysis, and financial statements prepared under IFRS. So if you think about the business concerns today in the coronavirus world, the demand for goods has been affected. In the lockdown situation, many entities have not been able to fulfill the contracts, or the demand has just dried up. There has been disruption to supply chain. And a key issue for companies is working capital or cash flows. Cash is the king today. And the key question that organizations should be asking themselves or are asking themselves, or if you are a reviewer of financial statements, should be thinking about organizations is, do they have enough cash, enough liquidity to continue in operation for the next 12 to 18 months? So working capital, cash flows is the key. And we also have legal implications. The force majeure clause that appears in many contracts, and with the coronavirus situation, which has been beyond the control of a lot of people, this clause has been enforced, and this has legal implications, impact on the business. But when we think about it from a financial reporting perspective, I would say there are two key high-level issues, challenges that we should be thinking about. And first of all, which I briefly mentioned about, is to do with going concern or liquidity. Does the company have enough cash to continue in operation for the next year or so? If it doesn't have cash, does it have access to facilities, or has it got any support from the government which will enable it to continue in business? And the entire lockdown situation where businesses are perhaps operating at a considerably lower capacity. Let's say, for example, 20%, 30%. That's what my friends say when I talk to them who are working in the manufacturing industry, at least some of them. It has an impact on the measurement of assets and also liabilities. So in this session, we will primarily be focusing on the going concern assessment and the impact on the measurement of assets and liabilities. Yeah. So I will hand over to Homiar, who will take us through the going concern assessment.
Good afternoon and good evening, everyone. Thank you, Sakit, for having me here. I'm going to walk through some of the key aspects of going concern one would expect to see in practice and one would expect to see in the financial statements, definitely over the next coming months. We've just gone past the June full year end. A lot of UK companies have a June year end, and of course March year end in countries like India. Some of the key considerations which trigger the going concern assessment, and I can see there are some non-accountants on the call. Going concern assessment or going concern is a very fundamental accounting principle which says the business is likely to continue indefinitely into the future and has enough liquidity and funds to do so. What's brought this into question is the COVID-19 crisis, where your demand, your business has pretty much in some cases disappeared overnight. Once that happens, you start having your liquidity and funding issues, which brings into question the going concern, and therefore the assessment which is required as a part of that. So whatever budgets, whatever plans people had prepared, the 3-year plans at the end of 19 for 20 to 23 and so on, all of those are pretty much on hold or definitely completely turned inside out with the way the crisis has evolved. So what do we see from a practical standpoint in a going concern assessment? First of all, there are multiple scenarios to figure out. I mean, if you talk to any economist, you talk to 5 of them, they'll have 5 different views, and economists generally tell you on one hand and then on the other. So they have a two-handed opinion on these things. That generally means either the economy is going to have a V-shaped recovery, U-shaped recovery, L-shaped. You can go through the whole alphabet. We don't know is the honest answer. And if we knew, we would be in a far better place than we are at the moment in the business and commercial world. So the first step of that going concern assessment by management will need to look at the overall scenario, the severe downside scenario. And what do we mean by the severe downside scenario? You'll have to be very adept at making financial projections, of course, but also looking at those projections to see which one of them is most likely, which one of them is going to happen. So if you're a restaurant business in London, if you have a lot of restaurants in the central part of London, people are not going into work. People are probably not going to work for the rest of the year or most of the year, and demand's fallen through the floor. What are you going to do with those restaurants? But you have out-of-town restaurants, chains, which will probably benefit or see some upturn in it. How do you model that? The severe downturn will also have to consider at what point you run out of cash. So what is the scenario under which, say we have another lockdown, which heaven forbid goes on for a very long time, what happens to your cash flows under that scenario? These assumptions and uncertainties are so severe that they will require extensive discussion in your annual accounts, in your auditors' reports, and so on. you can't get away from that, unfortunately. So the sooner you plan for that with your auditors, or the sooner you plan, more importantly, yourself getting these assessments done, the better it is. And of course, that will involve, in a lot of cases, difficult conversations with your lenders, with your investors, because either you're going to have to do a fundraise, depending on what your situation is, or have to ask lenders for forgiveness of just covenants probably at this point, but maybe eventually restructuring of those debts, which of course has its own complications from an accounting standpoint. And last of all, of course, you'll have the auditors coming in with full 2020 hindsight, trying to look at your business and understand whether you will survive for the next 12 months or so. I would say, for any controller, any CFO, it would be good if they start preparing their board, their investors, and their lenders today, if not earlier, about what's going to come out in the audit report and the financial statements. Because a going concern assumption sometimes might lead to a covenant breach within your loan agreements. So that is something, or you might be a guarantor company which has given loans or guaranteed loans of subsidiaries to third parties, and that could be in breach as well. So there are a number of aspects to factor in when you're going to do this going concern assessment. I doubt very few businesses are going to be immune from the effect of doing this exercise. And bear in mind, the auditors are completely swamped. The FRC has come out with detailed guidance on going concern, and the auditors have to go through all sorts of consultations and panels, and it could take up to 2 to 3 weeks for them to conclude whether you are you're sufficiently within the going concern assumption. And with that, we can go on to slide 9, which deals with an example from BP on the interim financial statements. So those companies who have a December year end have gone through their interim cycles, either quarterly or half yearly, pretty much now. The two biggest things you will see in a lot of these wonderful examples is going concern and how they see it. What are they doing to fix it from a cash flow point of view? And we'll talk about separately about impairments later on. But if you look at BP's example, it is a very good example of what the company is going to do to manage its liquidity. So they're going to stop their capital spending, which is around 12 billion. They are one of the biggest dividend payers in the FTSE, so they will have to think very differently about how much dividends they're going to pay out. What sort of expansion plans do they have? How will this recession driven by COVID-19 is going to really bring back and pull back companies' cash flows and people's spending, individual spending as well, unfortunately. So this is a good example of what they've done. They've been incredibly transparent, and those interested can go and look at this on BP's website. It gives a very good perspective on how they see the world. Moving on to the next slide, which is about the role of the auditor. The role of the auditor here is, it's a difficult one. I'm not saying this is an easy season for the auditors. Sorry, I've just got told to speak a little louder. Is that better?
Yeah, that's fine.
Okay. The auditors don't have it easy. The first disadvantage is complete information asymmetry. They don't know about your business and as much as you do, essentially. And that has its own problems. How do they judge whether you're going to make money in 3 years' time, 4 years' time? And I think what you need to do as people who prepare financial statements, review financial statements, is do your best to make their lives a little easier. I would say get all your assessments together, document them, provide them with as much scenarios as possible, and help them to understand your business better, because that will help them to actually proceed with how they would like to have the audit opinion turn out eventually. So there are 3 essential outcomes you could have this audit season on going concern. One is there is no issue, lucky. There'll be few businesses in the world which have absolutely no problem, and those will be things like Facebook, Amazon, Google, because their businesses seem to be, and Apple, whose businesses seem to be completely unaffected by any of this. Their supply chains are affected, but I mean, you know, the CFO of Apple is not really running around trying to raise funds in the secondary market or with loans and so on. So those will be fine. Then you have the next camp, which has material uncertainty, or where the business would have difficulties. They need to get certain funding in place. They need to get certain amounts of cash flows together, need to really take some active action. And those are the ones where there's the most debate will happen, where you'll have, you'll have to explain to your auditors with detailed scenarios, like I was mentioning earlier, and say, actually, we can survive if A, B, and C happen, and demonstrate to the auditors how that'll be, what actual active steps management is going to take. The reason I would say specify those steps, because every time they come into audit in 6 months, 3 months, whatever it is, you can go back to those steps to show what you've done in order to maintain liquidity and maintain financing, whether it's lender negotiations or cutting back dividends or capex. And the last camp, unfortunately, is your inability to continue as a going concern. So looking at the funding position, looking at your liquidity position, the auditor concludes this will be a company which is probably not going to survive the next 12 months. And that is a pretty serious thing for an auditor to put on an audit report. I've probably seen it 3 or 4 times in my 30 years of experience, where the auditors have concluded, not within the COVID-19 scenario, but have concluded that a company has a going concern problem. Notwithstanding that, what most companies will end up is the middle portion, where there is material uncertainty relating to going concern, and you'll have to do a lot of work in finance to establish to the auditors and the external world that you will survive. It's easy to find examples of material uncertainty, but I thought this was, I know it comes from very far away from where most people are, but this is AirAsia, which is a low-cost carrier, pretty much like Ryanair or Southwest in America, which is very popular all over Southeast Asia as a low-cost airline. Of course, that's where the pandemic originated, and it was the first ones to go into the lockdown. And these individuals just were finishing their accounts at that point in time. As you can see, their year end is 31st of December. Looking back with full hindsight, and at the end of March when these accounts were signed, the auditors have written a pretty extensive paragraph in their report. The auditors are Ernst & Young, pretty extensive paragraph. I would say most businesses will have to get used to these long paragraphs of material uncertainty, going concern issues within their financial statements. It is almost inevitable going through this process. So I would urge everyone to prepare your board, prepare your CFOs, and CFOs themselves should prepare all the investors and stakeholders that this is going to come, and this should not be worrying. All the auditors are trying to point out is there might be doubts about the company's ability to continue if the right things don't happen. So
right. So thank you, Homya, for that bit. So I think you made some very relevant points on going concern, but from your experience in the industry, if I was to ask you, what's the one key takeaway regarding this going concern assessment in the current environment? So what would that be? Just a brief answer on that.
I would say prepare different scenarios and make sure you test those scenarios to death until you're able to satisfy both your board as well as your auditors. That would be probably the one biggest important thing to take away from this. And I've seen going concern before as well, not just in this scenario, but where businesses have gone nearly bust on the back of a pension liability or market downturn.
Yeah, okay, no, that's very interesting. And I think the challenge with this environment is we don't know where the end of the tunnel is. So whether it's 2 months or 6 months or 10 months, we just don't know about it. So there could be lots of different scenarios.
Yeah, absolutely,
right.
Absolutely. Over
okay.
to you.
So what I'll do is just briefly talk about IAS 10 events after the reporting period. And this accounting standard deals with 2 types of events. One is events that you adjust the financial statements for, which are the adjusting events. So for example, if you had 31st December year-end reporting date, and we came to know about COVID-19 in, let's say, February, that's when it became a pandemic, or in March, do you actually adjust the 31st December financial statements or not? And if it's a non-adjusting event, then we probably make disclosures around the impact of that. So for most entities, 31st December 2019 would be a non-adjusting event. What we expect to see is more disclosures. And by non-adjusting, what we mean is, yeah, we would be explained like AirAsia has done about the impact of this pandemic, but we will not adjust the measurement of the assets and the liabilities. But for most of the periods after that, so 31st March and 30th June, it is going to be an adjusting events, and that would mean adjusting the assets and liabilities, the measurement of those as a result of the pandemic. And this is where the uncertainty arises and needs to be incorporated into the financial information that is produced. So one interesting example is TESCO, which have 29th February as the period end. And they actually concluded that COVID-19 has an impact. There will be some level of disruption, but in fact, they said that this for 29th February reporting date is a non-adjusting event because they're primarily UK based, and even in other countries where they are based, they said that COVID-19 and the impact of it only became apparent after the balance sheet date. So the consequences of such of the pandemic is a non-adjusting post-balance sheet event for 29th of February. But obviously, if you had a 31st March reporting date, then it would be an adjusting event, which means huge adjustments to the reported numbers, the assets and the liabilities. IS2 inventories. So inventories are your goods which are purchased and sold in the normal course of business, and it's an asset item on the balance sheet. And the fundamental principle here around measurement is whether it's carried at cost or net realizable value. And normally you would have the inventory at the cost of purchase. But because of the COVID-19 situation, we may see that there is a drop in market prices of goods, which might end up being below cost, or there might be inventory which is obsolete. We've had lockdown for a good few weeks, even a couple of months, more than that in some jurisdictions. So the inventory may have become obsolete, and that might mean impairing that inventory and taking a hit in the P&L. And another issue around this is the physical inventory count. So, you know, organizations and auditors do counts of physical inventory. And with the lockdown situation that we are in, it's impractical to do that in many jurisdictions. And as a result, the auditors may not be completely satisfied, and it may lead to a limitation of scope in the audit opinion. So again, something to think about for organizations which have inventory in locations or jurisdictions where physical count is not possible. Is there any other way that we can convince the auditors about the level of inventory and its measurement? So I will hand back to Homyar, who is a bit more of an expert, I would say, on impairment of assets than I am, and he will take us through the principle and some examples.
Thank you, Sakit. I'm not sure I would be calling myself an expert, but I have, for my sins, seen a lot of this more often to justify why there is no impairment than actually impairing assets. But here we go. So as you know, IAS 36, which is the bedrock of your impairment analysis, and where you've got to look at your carrying value and compare that to your recoverable amount. And the trick there is, which one do you use? Fair value in use, fair value less cost of disposal, or value in use. And you arrive at your recoverable amount. Hopefully that will be higher than your book value. So you don't have to book an impairment. However, in this scenario, when you do your value in use or fair value less cost of disposal, you are more likely than not to have a recoverable amount which is lower than your existing carrying value and therefore have a risk of impairment. My advice would be, if I were to do an impairment analysis of fixed assets, is to go with a fair value less cost of disposal approach in this sort of an environment, because it does take in a much longer term view of your assets. Of course, if you have value in use is very helpful if you've got very long-term assets. So you've got something which is going to last you 30, 40 years, like a blast furnace in a steel business, then that would help you to sort of, take a slightly longer view, and therefore your value in use might give you a higher recoverable amount compared to fair value. There are, like I said, very good examples available given the economic environment we are in. But one of them, which I thought was very clear, very transparent about the impact has on the business, is coming from Carnival. For those who are not familiar with Carnival, Carnival does cruises. So it is for people who, basically cruises for, they've got about, I think about quite a few ships, 100 ships or so. Substantially expensive ships. One of the latest ones was just under $1 billion. Brand new ship. I think it's about 3 or 4 years old, and I forget the name right now. All of these ships, obviously, after the coronavirus epidemic started, had to be docked. They can't even find enough places to put these ships away. So they've got $4 billion of assets just not being used, and that's a terrible tragedy. First of all, because those assets are meant to be running all the time, giving returns. But you can see what has happened on the 6-month comparison. I mean, it's not rocket science to figure out that their revenue is just half of what it was the same period last year. Mind you, the first half of the year is a busy cruise season. Everybody books a lot of the cruises, takes a lot of the cruises, particularly in America, which is one of the biggest markets in the world. That market has pretty much dropped off. It's because everyone tries to go to for cruises before June, before the hurricane season starts and so on. But you can see that there's been a complete fall off of demand. And that has brought them to a huge impairment, just under $1 billion of impairment for 6 months. From what I hear in the press, they're probably going to take another 1 to 1.5 billion in the second half because the market is just not recovering, and these ships have to be laid up. Laid up is put away somewhere where they can be brought back for use on a short notice, but that's also an expensive process. So that needs to be factored into your impairment. But as you can see, goodwill impairment is coming. Goodwill generally takes the first hit in any impairment analysis. And if you're doing, any impairment, your goodwill will take the first hit of this. And then we go into ship and other impairments. And you can see the loss which they've done. I think this disclosure is absolutely spot on in terms of what it's trying to do. It's telling you that this is directly an impact of COVID-19. The full extent is just not known yet, and these are the areas which are going to get affected: goodwill, trademarks, impairment, collectability of receivables, and so on. And there'll be provision for litigation as well, because there are lots of passengers who don't want to take a voucher and come again on the ship. They'd rather take their money back. So there's going to be a fair bit of litigation on that. And that puts another pressure on cash flow. You've collected the cash, you've used it, and now you need to pay it back to people. So this is, again, a very good example of how they've shown it in fixed assets. The disclosures are showing what is the fair values when they estimated the fair values and the discounted future earnings. I would have liked to see an interest rate, a discount rate clearly mentioned somewhere. It is sort of alluded, but that under IFRS, it's good if you can show the discount rate and perhaps sensitivities. So from that point of view, I did feel that disclosure was not complete, but I think they were transparent enough to put as much as they could. I think they would have done better if they put some sensitivity analysis to say, if demand doesn't come back, we're going to write off another $1 billion, for example. But maybe that was a bridge too far, and they would have breached their covenants on the back of that.
Yep. Okay, good. Thanks for that. So let me ask you a question. Obviously, we expect to see impairment of assets due to COVID-19, but do you think that companies might take advantage of this situation and perhaps impair assets uh, and say it's impaired because of COVID-19 when they should actually have impaired it in the pre-COVID-19 world also?
Very good point. And there are lots of industries like that. The short answer is yes, they will. There'll be a lot of people who will try to use COVID-19. I know at least one company who released their results in early July, which has done exactly that. They've taken a significant impairment, which was probably due years ago. So yes, there'll be companies which will do that, use this crisis as an opportunity to clean up the balance sheet. And I don't think necessarily that is a bad thing, as long as you get to the true values going forward, because then you can look at your realistic realistic return on capital employed. The other ones which will probably fall through that is people who have done big acquisitions just before. So people who bought significant companies with huge amounts of goodwill, that they will just be forced to take a write down. That is, I'd be very surprised to see in the second half of the year if there are no write downs. Thirdly, there'll be people who are going through a refinancing process, so they can't actually do a write down, even if they'd love to do a write down right now. So there'll be some of those. And in fact, you might breach covenants, your tangible net worth covenants. If you do a write down, that might take a hit. So those covenants are very important to be monitored closely when you're expecting these write downs.
Right. Okay. Excellent. Thank you so much for
But
that.
sorry, just one other point.
Yeah,
There was a
sure.
research after the last crisis in 2008. Just to go back to the very point you raised, will people take advantage and use this? In 2008, after the crisis, the Cass Business School did a very good study on impairment, of how many companies actually booked an impairment after the 2008 crisis. And the answer was, from a write-down percentage of assets, it would have been a great polling question anyway, but I'm just saying, for 0.52% of assets were written down after that crisis. That just sounds implausible, but it also says how much the companies got away with by not writing off the assets. So while I'm saying you can expect a write down, you can be surprised. And that Cass Business School study was quite seminal in that perspective.
Right. Okay. Excellent. Well, thanks for sharing that. Let's move on to leases, IFRS 16 leases. And in fact, I'm going to bring up a polling question before we look at the COVID-19. So if I give you about 45 seconds, the question is: the adoption of IFRS 16 leases, which is a new standard replacing IAS 17 leases from 2019, has maximum impact on the date of transition on, is it lessees with IAS 17 operating leases, lessees with IAS 17 finance leases, lessors with IAS 17 operating leases, or lessors with IAS 17 finance leases? So do select one. Just give you 10 more seconds. Great. I'm going to end the polling now. And I think rightly so, majority of you got it correct. It's lessees with IAS 17 operating leases. And what IFRS 16, for those of you who haven't been through that, is actually brings all leases on the balance sheet. So whether it's operating lease, finance lease, we don't have that distinction anymore. If you have a lease contract, then the lessee, the one who hires the asset, has to recognize a right of use asset and a lease liability, because there is an obligation to pay for that. Now, subsequently, those leases could be modified. There could be changes in that, and you have to go through the exercise of adjusting the asset and the liability. So as a result of the current COVID-19 pandemic, a lot of lessors and lessees are agreeing to rent concessions, that is relief to the lessees. And these rent concessions could be in the form of, let's say, a one-off reduction in rent, or it could be a deferral of rent, or even a change in the nature of rent from, let's say, a fixed rent to a variable rent, perhaps linked to sales. So these are different forms of relief which are given to the lessees. So the question that arises is, are these rent concessions a lease modification or not as per IFRS 16? And just to make life easier, a practical expedient has been introduced in the standard directly as a result of COVID-19. So what this practical expedient does is, if certain conditions are met, and we'll come to that in a bit, then instead of treating these rent concessions as lease modifications, you can take those as a hit to the, well, as actually an item in the P&L. So it's effectively a gain in the P&L because the lessee has got a benefit, a rent concession. So the conditions to be met for this are, first of all, that there should be an agreement between the lessor and the lessee about these rent concessions. And secondly, there should be a change in the lease payments, which results in a revised consideration that is either substantially the same or less than what it was previously. So you're effectively either paying less rent, or you are paying less rent now, but the lessor will be compensated later on for that reduced rent. And these reduction in payments affects only payments originally due on or before 30th June 2021. So there is a time limit to that. If as a result of the rent concession agreed, the payments beyond 30th June 2021 are reduced, then you can't take advantage of the rent concession. And the benefit of this, as I said earlier, is that these would then be treated as variable lease payments. And so instead of treating it as a lease modification, you adjust the liability for an amount that is not going to be paid and take it to the P&L. So the other interesting topic, and this can get really interesting if you go in depth into it, is IFRS 9 financial instruments. And I like to touch upon a couple of things in this standard. First of all, it's the restructuring of the loans. So if companies get to a stage where they are restructuring loans due to COVID-19, the question to ask from the standards perspective is, how significant is that restructuring? To what extent are the cash flows affected? And if it is a significant restructuring, then it effectively means that the existing loan is de-recognized in the financial statements and a new loan is recognized. Now, what is significant is not really defined in the standard, those of you who follow this and are accountants, but there is a best practice that if the present value of the cash flows change by more than 10%, then it is considered to be significant. And if that is the case, then effectively are de-recognizing a loan and the existing loan and recognizing a new loan. And what that means is there will be an impact on the P&L. The other area that is affected, and again, this can be quite huge, it applies to financial institutions, but also corporates, is the expected credit loss impairment. So what Homia discussed about earlier is the impairment of your tangible assets like property, equipment, ships that we looked at, and so on. Here we are talking about impairment of financial assets like loans or bonds. And the expected credit loss model is basically looking at three things to arrive at the impairment figure that should be recognized in the financial statements. So the first one is the exposure at default. So let's say you made a loan to a customer of $1 million. Now, you have got some security against the loan. And so the loss, if the customer was to default, is let's say 40%, because the 60% is covered by the collateral. So it will be $1 million times 40% loss is going to give you $400,000. And then you look at the probability of default. Let's say the probability of default is 5%. So 5% of 400,000 is 20,000. Take into account the time value of money, and that is the expected credit loss provision that you make in the financial statements. Now, what could happen as a result of COVID-19 is that the value of the security or the collateral could fall. So the loss given default could increase, or the probability of default, the risk of default could go up. And as a result, an adjustment will be required to the impairment provisioning figure. And if there is a significant increase in credit risk since origination due to coronavirus, then a full lifetime expected credit loss is required, even if there is no default. So just to be clear, expected credit loss is a forward-looking approach, and it requires assumptions and estimates around the collection of cash flows. And just as Homya said earlier with going concern assessment and perhaps even impairment, here we have to look at different scenarios and the different probabilities of default relating to those scenarios to come up with the expected credit losses. But what we would expect is entities to consider severe downside scenarios also. And one more thing here is also about the relief programs that are given by governments in some of the jurisdictions. So for example, let's say a bank has made a loan to a customer, $1 million. And now that customers run into financial difficulties, but a lot of the staff is furloughed and the government is paying their salaries. Now, in that case, even though there could be a risk of default, there could be an increase in the loss given default, because there is a benefit that is given by the government, we may not see a significant increase in credit risk. Normally in the pre-COVID-19 world, if there was a payment holiday given, we would have concluded it's a significant increase in credit risk. But here we may see some entities where the payment holidays are required, but for a short period of time, they will get back to normal in a few months, or they might have access to government relief programs or other forms of financing, and they should be perfectly fine. So in this case, the IASB, the International Accounting Standards Board, has come up with a guidance to say that there may not be a significant increase in credit risk, even though you have given payment holidays to certain borrowers. So if there is a payment holiday given to borrowers in a certain jurisdiction, which is like a blanket one to all of them, it may not lead to significant increase in credit risk. But the methodology that you use, the scenarios that you use, the probabilities of default that you use does need adjustment. And if this is something that affects you, then do also look out for the prudential and securities regulators guidance in your jurisdiction about what approach should you take. So again, this is quite an important important, not just for financial institutions, but also for corporates, because this trade receivables, for example, are affected by the IFRS 9 ECL provisioning. So I'll just hand back to Homya to just go through, touch upon, give a very brief overview of other standards that are affected, and also about interim reporting.
Yes, Thank you very much, Sakit. Looking at government grants, IS 20, I think that is more relevant if your government is giving any grants. A lot of countries, the government unfortunately have given none. So you might as well, forget about that accounting standard. But where companies have got soft loans from the government, or where people have been given furlough schemes and so on, you'll have to look at how IS 20 applies to some of those schemes, because those would need specific treatment, IS 20 government grants. Provisioning, no surprise there. You'll need to look at some of the provisions which you have, particularly around property. If you've got property which you're unlikely to use or is substantially affected by the crisis, then you have to look at those provisions again. People might find employee costs there. It's not because of restructuring costs relating to redundancies and so on, but it is more to do also with things where you have final salary pension schemes or defined benefit pension schemes, where the discount rates on those schemes have dropped. The liabilities are going to shoot up, and that is going to play havoc with your balance sheet. So that's something to consider within employee costs. Of course, there are elements of redundancy costs and so on, or restructuring costs, which will be covered by IS 19. And perhaps the biggest impact could also come from deferred tax assets. If you've been sitting on a lot of deferred tax assets in the hope that your future profits will offset some of them, unfortunately, those will be called into question this year end. Are you really going to recover those losses, or is this actually going to hit your P&L when you do that assessment at the end of the year? Or keep that deferred tax assets in mind as you do your going concern assessment, as you do your impairment analysis. So if you're getting to an impairment on your fixed assets in a particular jurisdiction, you will automatically have an impact, almost automatically have an impact if there's deferred tax assets in those jurisdictions. Going on to interim financial reporting, most companies, at least in the UK, will have gone past their half-year date on 30th of June, and so the timing of this webinar is not ideal from a point of view of getting some of the examples you will see in real life from some of the companies. But if you see companies like Shell, they have put in a big impairment at half-year end, particularly for the British gas exploration assets they pulled through, just because of the low carbon world and also COVID-19 depressing oil prices. So these transactions, you must remember, IS 34 looks at what has changed since you last reported your annual reports, and COVID-19 is obviously a huge change to your business model. And there'll be elaborate disclosures. Again, Carnival did some excellent disclosures, could have done better with some sensitivity analysis, is how I see it.
Yeah.
And, if you want to see, sorry. If you want to see
continue.
some great examples, yeah. If you want to see some very good examples of going concern, impact of COVID-19, please do see this thematic review from the Financial Reporting Council. That's the UK regulator of the audit profession and financial statements, and they review quality of financial statements. I think this, in the recent past, has been the best piece of research which the FRC could have put out. It came out literally on Wednesday or Tuesday or Wednesday this week, and they've identified holes in it, but they've also given great examples in there of businesses, retailers, everything you want to see, banks, to show what kind of disclosures companies are making. I encourage everyone to read it. It is quite an eye opener. It'll give you a perspective of what's coming this year for a lot of companies around the world. And it's there on my LinkedIn post as well. So please do have a look at this. It's if you just Google this term, you'll find it.
Right. Okay, excellent. So thank you for that, Homer. I think the key takeaways are there will be an impact, going concern, measurement of assets and liabilities, but also I think an important point to make is more disclosures in the financial statements because of the uncertainty that is involved. And as I said earlier, we don't know where the end of the tunnel is. So expect to see a lot more disclosures in interim reports and also the annual reports for 2020. So what I would like to do is open it up for questions. You can put up questions either in the chat box, or if you see the participants list and you can raise your hand, then I can unmute you. So feel free to do either of those. Nope. Let me just bring up one quick question. In the meantime, you can think about any question that you might have. But let me just launch this poll. So this is about the impact of COVID-19. Which one of the following affects your company or your clients the most due to the impact of COVID-19? Is it going concern assessment, IAS 36, impairment of assets, IFRS 9, financial instruments, IFRS 16, leases, or none of the above?
The none of the above must be from some advisory firms.
Or as you said, it might be Google or Amazon.
Yeah, it's seriously, there might be Google, Amazon, or Facebook in there somewhere.
Yeah.
I can see IFRS 9 affecting a lot of people. Yeah.
Yeah. So just give you 5 more seconds. Right, I'll end the polling now and share the results. So going concern assessment, quite a few of them. IFRS 9 financial instruments, again, not surprising. Expected credit loss has an impact on corporates, financial institutions. There could also be loan restructurings. So it's quite interesting. Going concern, we've done these webinars before, and going concern is what I have come across as appearing to be a real concern for many organizations. Okay, let me just see if there's any questions. There is one. So let me just try and unmute. So Anchita has a question. So Anchita, I'll just unmute you. Can you ask question? Raise your question.
Yes, sir. Sir, can you hear me?
Yes, we can.
Yes.
Yes, sir. So if we want to analyze the impact of COVID on test basis, like sample verification, so what will be the sample size and what will be the frequency and correct duration to ensure whether the things have impacted or not?
So Humia, do you want to answer that?
Sure. I was an auditor a very long time ago. I know you can't tell because I look so young, but a very long. The difficulty with the sample size approach is with COVID-19, there is really no sample size to decide or choose. You apply your normal audit sampling. The impact of COVID-19 is much more significant and much more broader than a few select transactions. I mean, if you look at the example we put up earlier, Carnival, their sales have just fallen down. So I actually expect the auditors will have to do more work to get the kind of coverage they used to get before, purely to make sure that, because of the crisis, the internal controls haven't fallen through the floor, people are working from home. those aspects will increase your sample size, but there is no real answer. I think a bulk of the work will be around the judgment of, can this business survive for 12 months? And do we need to write off their assets because we don't think they're going to come back? Like if you're in the airline industry, I don't know how you're going to convince people to get on the plane without a vaccine or without a real cure for COVID-19. So it's a very difficult, like I said, auditors have the most difficult job after management in looking at this. So I'm sorry, I couldn't give you a precise answer on that one.
So, sir, how to ensure that it has not impacted our internal controls within the organization?
That's why you'll have to test a bit. Your sample size will have to increase a bit more to test whether the internal controls are operating as you would have expected. And that's the real challenge, because as people are working from home, is there a tendency to circumvent controls, to switch off validations of transactions? Those are the risks you'll have to worry about. Are we making payments to suppliers whose bank details have changed and they haven't told us? So the risk of error, fraud, and general breakdown in internal controls is very real. And therefore, the auditors will just have to expand their scope of testing to make sure the controls are working better.
So, sir, any interim guidelines from the Institute of Chartered Accountants of India regarding the same?
I haven't seen anything. I would normally, on transactional level basis, your sampling needs to factor in the additional risk of COVID-19 and therefore expand your sample. I don't know, Saket, would you have anything else to add to that? Or?
No, I think you've covered, and it's a difficult one because of the unusual circumstances that we are in. But I think one of the things, and going back to the earlier slide about TESCOs, we looked at it when we were looking at post-balance sheet events, but one of the things they mentioned about is the increase in the discount rate, and we're quite interesting to see how that comes through, how they come up with those things. But yeah, I think it's difficult. I mean, there's no fixed sample size as such that we can take. It's just probably doing more work, and there are huge issues when I've spoken to some of my contacts in the industry about controls and audits, because people are not even able to go out of their homes to do stuff. So yeah, it's a very different environment compared to what we were used to. Yeah.
Okay, thank you, sir.
So I think, Homir, can you just mention again about the report? It's the Financial Reporting Council report that you've got
Correct.
mentioned about
so
on your LinkedIn?
Yep, so it's the Financial Reporting Council's thematic review. Quite a mouthful, but yeah. Definitely an interesting report.
Yeah, and it's available on the website.
Yes, it is available on the website, and it says 144-minute read, and I'm telling you, it'll take you a lot longer than that. It's quite an interesting read, actually.
Yeah. Okay. Right. Excellent. Let me see if there's any question. Oh. So there's a question here. I work in healthcare industry, and my company hasn't seen an impact from COVID-19. Do we still need to carry out detailed going concern assessment, considering our outlook for the next few years is very strong?
I forgot, amongst Google, Facebook, and Amazon and Apple, there is, of course, the healthcare business. It depends which part of healthcare you're in. But yeah, you're very fortunate, Arnindam. You will probably not need to do as much detailed work as possible, depending on the segment of healthcare you are in, and what its development looks like. But you will have to do something, because the auditors are worried that no sector is protected from this particular crisis. So you'll probably have to do some work, but I guess a lot less compared to, I'm not expecting, let's put it this way, not expecting material uncertainty on your audit report.
Yeah. Right, okay. And I think Shreya's got a question on how much capitalization of borrowing costs might be affected. And again, IAS 23 is the standard that deals with capitalization, and any abnormal situations, which COVID-19 is, I think you should not be capitalizing the borrowing cost during the disruption that is caused because of the coronavirus situation. So yes, I think there will be an impact on that. Yeah.
May I just add to that?
Yeah, sure.
When you're doing a loan modification or a refinancing, you'll have to be careful and see what IFRS 9 says as well, because some of your commitment fees, some of your debt issuance costs will have to be written off depending on where you end up with your refinancing. So that's a hit to the P&L. So you might have capitalized commitment fees, for example, or the cost relating to your previous debt issuance, if that is changing substantially. So it's an entirely new facility, not just a modification. You might end up with a substantial hit to your P&L, depending on what the tenure, what's left on your balance sheet, of course.
Yeah. Okay. Right. Excellent. So thank you so much, everyone, for attending, and do feel free to connect with us on LinkedIn. And if you have any other questions, feel free to email us. But thank you very much for joining, and hope you all stay safe and well. Thank you.
Thank you, everyone. Thank you. Bye-bye.